to this morning, but we certainly notched in life highs in trade yesterday. Let's welcome in Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers, with his thoughts. Manish, great having you. Thanks for taking the time out. I hope all is well.
Pleasure.
But not too much to complain, Manish, isn't it, with the markets doing what they are doing?
So the amount of liquidity that is there in the system, plus reports suggesting that USD INR carry trade has also started, and given that US is about to cut rates, this can only get exaggerated. So I think it's liquidity. Liquidity is driving momentum. Momentum is driving sentiment. Sentiment again moving the markets higher, and it's now into a virtual cycle. I think the key point to note out here is where is the valuation comfort, and most of the sectors are trading at higher valuations, but valuations are always a function of liquidity. So I think it is basically picking individual stocks. There's no point taking a call on the entire market, but broadly 75-80% of the market is trading expensive.
Manish, hi, it's also Samina joining in now. One more thing that I heard on the street, and please tell me if you're right or wrong, is that one of the factors that led to that big move in the second half of trade yesterday was probably the release of 3 lakh crores that was blocked out for the Bajaj Finance IPO. Is there any truth to this? Because I'm assuming if foreigners have come in to subscribe to this, and if the money has now been released, they might as well wait till the Fed cuts rates and then take the money out, right?
I mean, look, there is interest in India, that is for sure. And obviously, liquidity that was stuck in Bajaj Housing, could have got released second half yesterday or maybe today morning. Plus, the currency in the US doesn't look like too supportive at current levels. DXY is on a weakening path. So from that point of view, money is flowing to emerging markets, and a lot of that might come to India as well. And since large caps have not broadly done well in a while, we are seeing, more interest in large caps and primarily institutional money that could actually move the index even higher from these levels. Having said that, market cap to GDP, all those numbers have crossed all-time highs in India. So there has to be a word of caution around these levels. But it's basically the power of liquidity and momentum.
Absolutely. No one can fight momentum. We can just sit here and rationalize this differently every day. Manish, I know we've talked about large cap, and we've talked about large cap extensively from the mid of last year. Time and again, the anticipation has been that foreign money will come in, and when they come in, large cap is the space that goes up. But contrary to that expectation and belief, and I know a lot of portfolios were hoping and waiting on that, right? It's the broader markets that have witnessed outperformance. From where we stand, if we again hopefully lead from the front and the Nifty 50 becomes the first mover, where would the bias sit? What stocks would it be? Would it be banks? Again, that's a trade that hasn't played out yet after many months of waiting. Would you buy banks? If yes, would you buy private sector banks? And HDFC, ICICI, Kotak, still looking good for portfolio additions?
So, over the last few years, FIs have been net sellers. We have not got too much of foreign smart money or institutional money, so to speak. All of that has been primarily domestic money. And, the power of the markets has been led by the retail investor. And it's quite a matured set of investors, because India was coming off a low base, and numbers, the law of small numbers basically mean that small cap, mid cap segment growth rates in earnings were much higher than the large cap space. And obviously they have done much better than the large cap space. Now the valuations today, we are trading maybe 22 times FY26 numbers. Is that grossly expensive? No. In 2007-8, we have gone to as high as 25p on a one-year forward. Can markets move to those high levels? Yes, it can. But 3 out of 4 names across the market, whether large cap, mid cap, small caps, are expensive. Out of 57 sectors that are there in it. Where do we hide in this sort of a market? I think the idea is to buy into moderate growth companies at moderate valuations rather than looking to buy the best growth companies at the highest valuation. In this way, one can actually reduce risk. Sectorally, you can hide in pockets like banks, financials. This includes insurance or health insurance or fintech or platform companies in the fintech space. You could find shelter in IT companies because IT companies would likely do well beginning second half of this year, continuing into the first half of next year. And obviously rate cuts in US is only going to help. And the third is obviously a lot is happening in the pharmaceutical space, considered to be a defensive space. And India has got new growth triggers for it to carry forward. It's a very large space. So I think these are broadly sectors where one can find some solace. One dark space, dark horse, so to speak, is basically your housing, building materials. Post-election announcements last year, the space has been quite subdued. There has been correction. We have seen the interest that is there in mortgage finance companies. There's a precursor to what you could see in the actual housing space, across all parameters. So I think these are the four areas where I would find comfort. Taking money off the table in top-down brilliant sectors like your capital goods, defense, railways, I get it. It is a fabulous sector from the next 5-7 years point of view. But near-term valuations are probably discounting the next 5 years of earnings. That is to say there has to be a lot of price and time correction if one needs to make money. So not yet there in terms of what the correction has to happen in this space. So broadly taking money out from that space. This is how I'll be actually strategizing my portfolio.
Okay, Manish. The other question is you spoke of USD INR strength. There is clear direction of crude, even if there is piecemeal bounce backs that happen. Does all of this therefore augur well for directional flows from the global side into India? Because we know that the domestic money is there. So that is continuing. Can global money come in because of all of these factors, because of positive Indian macro and rate cuts all happening, even at these valuations? And therefore, does it take the markets to bubble territory?
Surely can happen, Neeraj, because as I said that if the dollar index is to weaken, and it has been weakening, emerging markets do tend to be getting the flows. And this has happened in the past, and obviously this time around also, this is likely to happen. In this entire equation, China is on a back burner. So the next big Indian market and next big emerging market is basically India. We have started seeing off late a lot of USD INR carry trade happen because they borrow in USD, and because interest rate cuts are happening, there would be a tendency for the dollar to even weaken further, triggering further carry trades into India. From that point of view, I think where will the money go? I mean, the first allocation will be to the large cap index names. It's going to be a beta play because you are clearly minimizing your risk and earning that spread. And this will have a bearing on your Nifty 50 and BSE Sensex, to say the least. There would be certain spaces which would get higher allocation within the Nifty 50 sectors where there has been some degree of underperformance. Margin of safety in terms of valuations are clearly there. The financial space, the IT, the pharma, and the others would within the Nifty would be slightly underweight. So in that I think the best way to play with this is basically smart beta within the index names. And that is how this is likely to play out. So it can go into a bubble territory because markets move on liquidity, and there's plenty of liquidity that's waiting to come to India. August was the first month that we saw that there has been institutional buying worth 35,000 odd crores net positive. And that augurs well, and it's a precursor to more things like this to come.
Well, music to the ears of the bulls, great for fund managers, great for news channels to report on. So, well, everybody's happy. Manish, all the best for maybe a continuation of a very strong ride. But thank you so much for talking to us today. It was important to have you. Thank you.